Ever wondered how some people manage to grow their wealth exponentially? The secret often lies in equity investments. You see, equity investments are essentially buying a piece of a company. When you invest in equities, you purchase shares of a company, making you a partial owner, and this ownership stake gives you a claim on the company's future earnings. It's a bit like planting a seed and nurturing it into a tree. You invest your money, your time, and your patience, and in return you get the potential for significant financial growth. Equity investments have the potential to outperform most other investment options over the long term. They're the engine that can propel your financial rocket to new heights, but just like any engine, they need to be operated with care and understanding. Equity investments, therefore, are a powerful tool for wealth creation if used wisely. Now that we know what equity investments are, let's dive into the world of the Indian stock market. This dynamic market is an integral part of the global financial ecosystem, contributing significantly to India's economic growth. The Indian stock market, consisting of the Bombay Stock Exchange with over 5,000 listed companies and the National Stock Exchange with more than 1,600 listed companies, is one of the largest in the world by market capitalization. It's a vibrant marketplace where millions of transactions happen every day, reflecting the pulse of India's economy. But why is the Indian stock market so important? Well, it's a platform where businesses raise capital to fund their growth and operations. It's also a place where investors like you and me can participate in the financial success of these companies by buying shares or equities and potentially earning returns on our investments. Getting started with equity investments in India involves understanding the regulatory framework. The Securities and Exchange Board of India, or SEBI, oversees the market operations to ensure transparency and protect investors' interests. It's important to familiarize yourself with SEBI's guidelines before plunging into the market. You'll also need to open a demat and trading account with a registered broker to start buying and selling shares. Remember, it's crucial to do your homework and research the broker's credibility and service offerings. The Indian stock market operates on weekdays from 9:15 in the morning to 3:30 in the afternoon, Indian Standard Time. During these hours, you can place orders to buy or sell shares and watch the market movements in real time. Another important aspect to note is the market indices. The Sensex and the Nifty are two major indices that represent the Indian stock market's performance. They are made up of a set of top-performing companies across various sectors, and their rise or fall gives a snapshot of the overall market sentiment. Equipped with this knowledge of the Indian stock market, you can start exploring your investment options. There are three main avenues for equity investments: individual stocks, IPOs, and ETFs. Let's start with individual stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of the company and its future earnings. This is a direct form of investment where you can potentially reap significant rewards if the company performs well. However, the risks are also high because your investment is concentrated in one company. The key to successful stock investing lies in thorough research and analysis, picking the right stocks at the right time, and patience. Next, we have initial public offerings, or IPOs. These are opportunities to buy shares of a company before they are traded on the open market. IPOs can be exciting because they offer the prospect of substantial gains if the company's stock price rises significantly after the public listing. However, not all IPOs live up to the hype, and some can even lead to significant losses. Therefore, investing in IPOs requires careful evaluation of the company's business model, financials, and the price at which the shares are being offered. Lastly, we have exchange-traded funds, or ETFs for short. These are investment funds traded on stock exchanges, much like individual stocks. An ETF holds assets such as stocks, bonds, or commodities, and it aims to track the performance of a specific index. The beauty of ETFs lies in their diversification. Instead of putting all your eggs in one basket, you spread your investment across a basket of stocks. This reduces your risk, as the poor performance of one stock can be offset by the good performance of others. However, the return potential may be less than that of individual stocks. In essence, individual stocks offer the highest potential return, but come with high risk. IPOs provide the thrill of getting in on the ground floor, but require thorough due diligence. And ETFs offer a balanced approach with diversification and lower risk. Each of these investment options has its own benefits and risks, and it's important to understand them before investing. Scene script. Like any investment option, equity investments come with their own set of benefits and risks. Let's start with individual stocks. The primary advantage of investing in individual stocks is the potential for high returns. If you pick the right stock at the right time, you could see substantial growth in your investment. However, the risk is just as high. If the company underperforms or if the market takes a downturn, you could lose a significant portion, if not all, of your investment. Next, we have initial public offerings, or IPOs. Investing in an IPO can be exciting. You're getting in on the ground floor of a company's public journey, and if the company does well, so do you. The flip side is the uncertainty. Not all IPOs are successful, and some companies may never live up to their initial hype. Therefore, it's crucial to thoroughly research the company and its prospects before investing. Then there are exchange-traded funds, or ETFs. The main advantage of ETFs is diversification. Instead of putting all your eggs in one basket, you're spreading your investment across a range of companies. This can help to mitigate risk, but remember, while diversification can protect against the poor performance of a single stock, it can't shield you from broader market downturns. In addition, it's worth noting that all equity investments are subject to market risk. The stock market can be unpredictable, influenced by a variety of factors, from economic indicators to geopolitical events. However, with risk comes potential reward. Equity investments offer the chance for significant returns and can be a powerful tool for wealth creation. They also allow you to be a part of a company's journey and potentially profit from its success. Remember, the key to successful investing is informed decision-making. Research your options, understand the risks, and make sure your investment decisions align with your financial goals and risk tolerance. Knowing these benefits and risks will help you make informed investment decisions. The key to success in equity investments often lies in the strategy you adopt. Let's dive into some strategies that could potentially help you unlock wealth in the Indian stock market. Firstly, there's buy and hold. This strategy is based on the belief that in the long run, the stock market will provide a good rate of return despite periods of volatility or decline. It involves buying stocks and holding onto them for a long period of time, irrespective of market fluctuations. Next is dollar cost averaging. This approach involves investing a fixed amount of money in the market at regular intervals. This way, you buy more shares when prices are low and fewer shares when prices are high, reducing the impact of market volatility. Then we have diversification. It's about spreading your investments across different types of assets to reduce risk. For example, instead of investing all your money in one stock, you spread it across multiple stocks, sectors, or even asset classes. And finally, the contrarian investing. This strategy involves buying and selling in contrast to the prevailing sentiment of the time. A contrarian investor enters the market when others are feeling pessimistic and sells when others are optimistic. Remember, a good investment strategy is one that aligns with your financial goals and risk tolerance. So, always consider these factors while choosing your strategy. Staying updated with market trends and understanding the do's and don'ts of equity investments can make a world of difference to your investment journey. In the ever-evolving world of finance, market trends hold great significance. They are like the tides of the ocean, guiding the direction of your investment ship. Currently, we are witnessing a surge in the use of technology in equity markets. The rise of digital brokerage platforms has made investing more accessible, while algorithmic trading is reshaping the trading landscape. The trend towards sustainable investing is also gaining momentum. Investors are increasingly considering environmental, social, and governance factors while making investment decisions. It's not just about the returns anymore, it's about making a positive impact. Now let's talk about some do's and don'ts. Do diversify your portfolio. It's a time-tested strategy to mitigate risk. Don't put all your eggs in one basket. Do invest for the long term. Equity markets may fluctuate in the short term, but they have historically delivered solid returns over the long haul. Don't let emotions drive your investment decisions. Fear and greed can lead to poor choices. Stick to your investment plan and stay disciplined. Do keep learning. The world of equity investments is vast and constantly evolving. The more you learn, the better equipped you'll be to navigate it. Investing in equities can be a rewarding journey if you stay informed, make wise decisions, and keep learning.